Welcome to the Wealth Studying Podcast. This is episode 475. Today is June 26, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, hey, today I want to point out some realities of the nonsense 24-hour news cycle. I want to frame this up in terms of what we've just recently seen with the bombing of Iran, which has been the story that the media has loved to cover. But the real story is what's going on with OPEC. And that's generally not in the headlines. That's really what investors should be focusing on, though. Hey, so to frame this up, as I record this, there's very little in the media now about Israel and Iran and the bombing of the nuclear site, other than to second guess it and to figure out how much damage was or wasn't actually caused at the site. And it's more about finger pointing and blaming and red team, blue team, or USA versus the rest of the world. But in any case, just again, think back. Last week, the major story was that we were on the threshold of World War III. Now, I can't tell you how many times over my life I've heard that mantra that never pans out. And specific to that, again, over my lifetime, I can't tell you the number of times I've heard that we're about to go to war with Iran or that there's going to be a major U.S. bombing of Iran, and I got to tell you, this is really the first time in 50 years that it's finally happened. You can go back to every president since Jimmy Carter, and whether they implicitly or explicitly stated it, or whether there was rumors that it was going to happen, consistently for the last, nearly 50 years, through every administration, whether it was red team or blue team, Iran has been an enemy, and there was at one point or another during the administration's tenure that there was a rumor of an imminent attack or bombing on Iran. And hey, I'm not making value judgments here as to whether any of that was warranted or not warranted. I'm an investor. I'm just focusing in on the media narrative versus what actually happens in the markets. And you'll notice that I didn't do any podcasts while all this hysteria was going on about World War III or about bombing Iran or about the war in the Middle East. Because frankly, as to quote my Italian grandfather in his broken English, I think it's all bullshita. Again, in terms of how it's being programmed and packaged in the media, regardless of the source, whether it's coming from red team, blue team, pro-red, white, and blue, or anti-red, white, and blue. It's all bullshita in terms of how it's going to negatively impact the stock market or the economy, or specifically things like energy costs and the price of oil. And one reason you knew that long before military actions took place, and in fact going back even farther than that, you could have looked at little tells in the stock market and in the economy that something was imminent, probably about to happen, and it wasn't going to probably be World War III, and it wasn't probably going to result in a market-crushing event. I say probably because none of us can predict the future. I certainly can't. And from the emails and contact I get from listeners of the podcast, I can surely tell you none of you guys can predict the future either. Not to mention the idiot talking heads all over the media. But what was the big tell? You go back to April. A very curious thing happened. In fact, let me read you one of the headlines. Okay, I have in front of me a headline. It's dated April 4th, 2025. This was from Reuters. And their headline is that OPEC unexpectedly speeds up oil output hikes. And then the subheading, oil drops. Yeah, so think about this. We have come into this year with an abundant oversupply of global oil. That's for a number of reasons, and I'll just highlight a couple of them. Number one is the economy in China has not ever fully recovered since the pandemic. So that's one thing, the big point I think that more than anything has driven down global energy consumption, specifically oil consumption. And of course, there's been adaptation of electric vehicles over the last 5 or 6 years, so that's bitten into some of it, as well as just internal combustion engines continue to get more efficient and use less oil-derived products. And another big reason for the glut is that there just continues to be abundant reserves that are economically available given the drilling technologies and the exploration and extraction technologies that we have, which have consistently gotten better over the last couple decades. The world is literally awash in oil. If you're a long-term listener to the podcast, you know that I've always been a proponent of owning energy stocks. Prior to the pandemic and even during the pandemic when oil took a big dip, I was happy to buy into that dip. I held most of those positions until, I think it was just the end of January of this year that I sold my overweight position in things like ExxonMobil and Chevron. I don't buy, or generally don't buy into oil ETFs themselves. Rather than owning commodities, I'd much rather own the profitable companies that are involved in the supply chain of the commodity, rather than owning the commodity itself. But in any case, I sold those positions. I think it was late January. You can check the blog post over at investablewealth.com to confirm that for me. But my rationale there was not so much the overall straight capacity of what was in the system, but the fact that Trump's mantra was drill, baby, drill. And, 2020 hindsight, I should have actually sold my oil positions more around November, December timeframe, because counter to what a lot of people thought, with Trump being pro-drilling for oil, that in the short term is not necessarily good for oil prices or certainly the price of oil stocks and oil producers because it just creates more short-term capacity. Now, I did not get rid of my positions in oil stocks. I just went from an overweight position to, probably an underweight position at this point, but I still own ExxonMobil. I still own Chevron. I own some probably other related things as well. I certainly own the drilling services companies like Schlumberger and Baker Hughes. And the reason for that, well, again, number of reasons, but specific to the exploration and drilling type companies, I think they do have upside potential, not only in application, but specifically in cost of doing business as it could relate to two areas. One being deregulation in the U.S., whether that means opening up additional oil exploration on federal lands, or even in non-federal lands in places like Alaska or in the Gulf of Mexico, or even deep water drilling in the continental shelf around the U.S. Any type of reduction in burdensome regulation has a more positive impact on profitability than just about any other input, more so than labor cost or the cost of steel pipe, or any of the other components that go into exploring for oil. So deregulation, whether it be in the form of, again, federal lands or deep water drilling or, back to Alaska, whatever it be, that can be a very positive impact to further increase the overwhelming production in North American oil that we've seen in the last couple decades. The other component, especially in terms of the oil exploration side of it, is that I think we're going to go back to seeing growth in overseas exploration by U.S. companies. Eventually when things get resolved with Ukraine, I think it's a very likely scenario that you'll see U.S. companies, both in terms of direct oil companies like ExxonMobil or the Baker Hughes, drilling type companies of the world that go into Russia, go into Ukraine, and go into other parts of the world that have, for the last many years been kind of off limits to U.S. companies. I think you're going to see them going back in. So yes, there is a place for oil companies and oil exploration and drilling companies in my portfolio. It's just a lot smaller than it has been over the previous 5 years or so. And I don't want to get too much off track here, but I also am a huge believer in natural gas. And to the extent that there may or may not be some future reduction in oil consumption, and by the way, we're really not seeing that. I mean, overall, the growth rate is still there. It's just slowed down in proportion to what it was. And while that may be slowing down a little bit, mostly as population slows down, what you're going to continue to see, what I believe is exponential growth, is going to be in natural gas, and whether that's regular pipeline usage here in the United States for energy, or whether it's converted to liquefied natural gas for exports. And while long-term things like nuclear energy will most likely fill that void, that's a long way off in the future. And until then, the United States has abundant amounts of natural gas to use internally as well as exporting. And again, to me, that's another case for why you would want to have these Schlumbergers and other companies in the portfolio, because they're going to continue to be key players in the natural gas supply system. But I digress. Now, let's see, where was I at? Let's go back to this Reuters headline. Okay, Reuters headline April 4th, oil prices drop, and the headline is that OPEC unexpectedly speeds up oil output hikes. I mean, that's just a long way of saying that OPEC is no longer curtailing their oil production. If you remember going back all the way to post-pandemic hysteria 2022, OPEC started cutting their production so that they could keep the price of oil high. They generally like to keep it at or above $80 a barrel. And following the pandemic, especially when all the U.S. shale oil production started to come back online, the price was going down and OPEC wanted to cut at least their production to stabilize the supply and keep the price from dropping, back to those $40 and $50 levels that we've seen in previous oil busts. Now, I really think that OPEC thought that this was going to be short term because they assumed that once China fully opened, because remember, China didn't actually open until December of 2023 is when they really got rid of their draconian pandemic lockdowns, which, again, crazy to think about. But I think the general thesis was that once that happened, oil consumption would go back to where it was and everything would be hunky-dory with OPEC. Well, that didn't happen, and so those short-term curtailments ended up lasting not just 6 months or a year, but pretty much through the end of 2024. I mean, they started getting lifted, or at least rumors they'd be lifted, sometime late last year. But the interesting thing, and this is the tell on what I think ultimately ended up being the attacks on Iran by not only Israel, but then the subsequent bombing by the U.S., was that in April, even when the world is still awash in oil, OPEC suddenly decides to put more oil on the market. And then within 5 or 6 weeks, Trump is in Saudi Arabia, Trump is in Qatar, Trump is in the Arab Emirates doing business deals. And again, they agree to further increase their oil output in a world that's already awash with an oversupply of oil. And then literally within 4 weeks of Trump's Middle East visit, Israel starts the preemptive strikes on Iran, and then in short order, that's followed up with the U.S. bombing of the proposed nuclear sites. So that's the key events. Unexpectedly, OPEC starts producing more oil in April. Trump conducts the deals in May. Bombings start in June. That convenient collaboration between the Israelis, the U.S., Qatar, Saudi Arabia, United Arab Emirates, and I'll throw in Russia there, even though Trump didn't visit Russia on that trip. They were, I'm sure, complicit in this. All these people benefited from stabilizing oil prices not to go too high during the attacks, because I think they were all in the fact that at least some form of aggression was going to take place, whether they knew exactly how this was going to play out or not. There's no way you can convince me that Saudi Arabia was going to drastically increase their oil production ahead of schedule in April, if for no other reason than they wanted to stabilize prices during whatever turbulence was going to be happening in the Middle East in June, because they don't want oil going to $150 a barrel like we've seen in the past, because that would encourage additional production that they don't want. Remember, they want to keep oil high enough, around $80 a barrel, to make it very profitable for them, but not so high that it causes marginal producers to produce more. And this is a definite case of follow the money. Cui bono, who benefits? OPEC, U.S., Russia as part of OPEC Plus, and even China as a major consumer of not only Mideastern oil, but specifically Iranian oil. The entire shell game of sanctions on Iranian oil has been nonsense. And you'll see criticism this past week about Trump actually lifting the sanction on Iranian oil so that China can buy it. Well, step back and really think about this. Those sanctions never did anything anyways. I've seen estimates that at least 90% of Iranian exports were still making their way to China. And really all it did was it caused Iran to get a lower price for their oil, which is kind of the same thing we've been trying to do to Russia, not to keep their oil off the market because that would put the global economy in a recession. We still want these countries to sell oil. We just want to limit how much money they can make off of it. But the bottom line is it doesn't stop the flow of oil, it just impacts the price. Now you may be wondering, why then would Trump allow China to now legally purchase Iranian oil? My argument would be because Trump would actually rather hurt China more so than Iran, at this point anyways. And the reason it hurts China is because China will actually end up paying more for Iranian oil than they did under the embargo because they were buying it in the gray market when they were skirting sanctions, and they could get it at a lower price generally. All these things are connected, and they're connected to support the global economy. And so when you hear the Doombergs of the world and the Goldman Sachs, which are telling you that oil's going to $130 a barrel, it's all nonsense to create short-term volatility in the markets. These players, the key global players, the people that control things, they knew darn well that any disruptions to either the Straits of Hormuz or just general oil flow out of the Mideast, to the extent that it was interrupted or hampered, it was going to be short-term. And specifically, again, getting back to why this is beneficial for companies like Saudi Arabia, who have cut their market share and their production over the last 3 years, they are sitting just in Saudi Arabia at least 2 million barrels a day of oil they've taken off production, and they have readily accessible surplus oil capacity. And do you know what that matches up to almost exactly? That 2 million plus barrels a day? It's almost exactly what Iran's total production capacity could be. So even if you took all of the current Iranian production capacity off the market, Saudi Arabia could easily make that up in just what they've curtailed in supply over the last 3 years. And then you step back even further and you look at OPEC in general and specifically the Middle East. They're sitting on probably 5 or more million barrels a day combined of excess curtailed oil supply. So other than a really short-term spike in oil prices caused by a short-term shutting off of something like the Straits of Hormuz, there was no way that oil prices were going to go, in excess of $100 and cripple the global economy. It just wasn't in the cards. All this was all pre-planned. It's a shell game charade where all these global powers collude with each other. From the Russians continuing to stir up problems in the Middle East because any type of turbulence in the Middle East keeps oil prices high, so that definitely benefits the Russians, as well as the Saudis and everybody else. Oh, by the way, including the United States oil producers, because now we are a powerhouse. And our national security is much less fragile and reliant on non-North American sources of oil than we were just, 20 years ago. So the key producers of oil like to stir things up in the Middle East to keep conflict, to keep oil prices at a profitable level for them. And at the same time, the consuming nations, people like China, people in those other countries in Asia, which are getting the vast majority of the Middle East energy coming to them, well, they also have a hand in this to ensure that a rogue country like Iran isn't going to get too far out of hand. So this is yet another incident of where, if you're paying attention to what the market's doing, i.e. the price of oil, which despite all the gloom and doom fears of World War III, never got above the average price of oil all of last year when there was no threat, right? That's how one of the ways you would know that this was all political theater. In any case, just my opinion, take it for what it's worth. Until next time, as always, this is John Pugliano wishing you the very best returns.